All right, here we go. All right, TGIF, that's for darn sure. Today is the day that we all get to look forward to Monday, where we enjoy 2 free trading days of theta. That's right, while the market's not closed, options are worth less and less, especially out of the money options. When we get back on Monday, those calls and put spreads that we're short are going to be worth even less. That is music to an option seller's ears. Okay, we're going to beat a couple of dead horses today. Yesterday we put out a Chartly. You can go to www.chart.ly, okay, Chartly. It's a StockTwits service, and check out the work that we did on HSFT. That's HiSoft. I know we've been harping on it, but the reality is, as I look at a chart of HiSoft, HSFT, you'll notice that on the channel that we drew for you guys on that Chartly video, it is literally bouncing along the support line right now. It has a very well-defined channel on a 3-month chart, and we are at the bottom of support. Okay, we have not broken to the downside. That was always the concern, right? I said in the video that if you get a close below $27 a share, especially for more than one day, then you need to be concerned that the stock would trade down to at least about 24.5. Okay, take a look at HSFT today. It's only down about 2 cents. It is just hugging that line of support, which we think is a good line to get long. Okay, another dead horse that we have to beat a little bit more. Bonds. Okay, the PZA. Okay, is the Power Shares Insured Municipal Bond Fund. Okay, so 97% of the bonds that are held in PZA are insured, but that does not matter, okay, for 3 reasons. 1, companies like GE, Microsoft, Freeport-McMoRan, Cooper Industries, Coke, they've all raised dividends this year. The more stocks that raise dividends, the more attractive dividend-paying stocks become as opposed to bonds. Because dividend-paying stocks, the stock themselves can go up in addition to being paid that fixed dividend every quarter, with the possibility of rising dividends. Okay, a bond, when they issue that sheet of paper, there's a printed interest rate on the bond. That thing's never going up. Okay, and as inflation rises, number 2, as inflation rises, the price of the bonds declines in order to match the printed interest rate on the bond with market interest rates. That's a very dangerous situation. Okay, so even on a bond, a piece of paper that's paying 5%, if interest rates rise, and we all know that with them at 0, the only place they can go is up, and market interest rates have already risen, that means that those pieces of paper, those bonds that you hold long, especially municipals and government securities and low-yielding corporate bonds, okay, those things are going to trade down. The principal amount will trade down in order to rise the yield, as opposed to a healthy company that can raise its dividend without, in fact, not only not causing the stock price to go down, but if you raise the dividend on a stock, the stock price is going to go up. Take a look at GE today. That's a perfect example. Okay, anyone that doesn't believe that inflation is coming, if you can find a gallon of milk for less now than you paid a year ago, you can call us, send us a message on Twitter, and we'll send you out a prize, because gasoline and milk are both up dramatically this year. I was talking with someone this morning that said milk is up somewhere around 30% year over year. That is a huge increase. We all know that with oil around $90 a barrel, that gas is up. Okay, so inflation is real. Thank you, Ben Bernanke. That's actually his job. He wants to monetize the debt, meaning we pay back our debts that the government has borrowed with cheaper dollars in the future, right? So that actually helps our exports, and it helps monetize the U.S. government debt. Both are good, unless you're holding our debt, which is why I'm telling you should sell bonds. Okay, the third thing, about $700 billion has gone into bond mutual funds over the last 18 months. Well, when a guy like Bill Gross from PIMCO, who is the bond king, tells you I'd rather own stocks than bonds, I think we should be concerned. In fact, anyone that owns bonds, when the bond king tells you to sell them, I think you're just asking for it. It's like pulling the fire alarm in a crowded movie theater. Somebody's going to get trampled. So be the person that's outside from your new destination, watching the people exit. Don't be the person in the line trying to exit your bond trade. I know on February the 12th, we wrote an article called Bail on Your Bonds. If you want to learn more, go to magnumopusfinancial.com. Scroll down a little bit. You'll see the MOF News Network. I think the top right-hand button is the MOF blog. Click on it, and you can find the article in the month of February. There's a list of the calendar on the right-hand side. Click on February. You'll see the article Bail on Your Bonds. And there's more details there. But the bottom line is there's three very good reasons to sell your bonds. Inflation, not only is it coming, but it's here, and that is the enemy of all pieces of paper with printed coupons, bonds, right? Because remember, stocks, the company can choose to raise the dividend, like a Freeport McMoran who just gave you a 2-for-1 stock split plus a $1 special dividend. Okay, and then so inflation is coming. There's too many people. Do you talk about a crowded trade? Do you think gold is crowded? Yeah. Look at $700 billion went into bond mutual funds. Okay. And then third, what was our third reason for not liking bonds? Because really just when you put them up against dividend paying stocks, they look worse. Okay. Stocks have the ability to appreciate. Bonds are only going to appreciate so far past par. Remember, par is the even amount where the bond, right, the face amount of the bond is. So it gets issued at $100. Almost par for almost all bonds is $100, and in some cases $1,000. Okay, that's what you're going to be redeemed at. If they called the bond and they're going to pay you all of your principal, you're going to get $100. So you have very limited upside on a bond. It's very much designed for people that want that income. Okay, so stocks are more attractive. Inflation is here, and it's a super crowded trade. Okay, so we wouldn't tell you to get out of something without telling you to give you an option into what to get back into. So we like Total, TOT, Calumet Specialty Products Producer, CLMT, TD, Toronto Dominion, DD, which is DuPont, and then TEG, which is Integris Energy. Okay, so you've got a major integrated oil company, a Canadian bank, a specialty products producer, a basic materials and chemicals company with some exposure to the agriculture bull market with DuPont's seed business, and TEG, Integris Energy, which is one of the original members of the original Dow Jones Industrial Average. So the company's been around for over 100 years. Check those out. They all have better than 3% dividend. Okay, TOT, TD, CLMT, DD, and TEG. Thanks again for tuning in today. You'll have to go back and pull the old Lunch of the Market editions if you want the details. There is an episode for each one of those stocks, so you go back and check out why the fundamental reasons we like them in addition to their 3% dividend. Thanks for tuning in today. Have a great day, and we'll see you on Monday.